Synthetic CDOs. That is fucking crazy.
It's awesome.
The Big Short gave us a front row seat to Wall Street, a world driven by greed, ego, and blind faith in complex financial products nobody fully understood. But beneath the Hollywood storytelling was a terrifying truth. Wall Street turned debt into a ticking time bomb, and when it finally went off, the shockwaves hit the entire world. By 2008, these little boxes of debt, CDOs and their evil twin, the synthetic CDOs, had mutated into trillion-dollar bombs, powerful enough to bring down the global economy. So what exactly are these financial products? And why do they still exist, even after turning the housing market into the biggest casino the world has ever seen? It all started in 1987. On Wall Street, greed wasn't just good, it was the business model. At Drexel Burnham Lambert, junk bond king Michael Milken created a product that sounded boring, but was pure financial alchemy, the collateralized debt obligation, or CDO. But what exactly is a CDO? Let's break it down. First, collateral. Imagine you borrow $500,000 to buy a house. The bank says, if you don't pay us back, we'll take the house. The house is the collateral, the safety net for the bank. Next, debt. That's just borrowed money you've promised to repay. Mortgages, car loans, credit card balances. Your legal commitment to keep paying that debt. Put it all together, and you get a collateralized debt obligation, a product that bundles thousands of loans into one giant package and sells it to investors. Think of it like a big box stuffed with mortgages, car loans, and credit card debt. Investors buy slices of that box, hoping to make money from the interest payments people make on their loans. For example, a bank might hand out thousands of mortgages. Instead of holding onto them, the bank stuffs them into a CDO and sells them. If it's only mortgages, it's called a mortgage-backed security, MBS. If it includes car loans, credit cards, or business loans, it becomes an asset-backed security, ABS. CDOs are called derivatives because their value depends on the assets inside, the mortgages, car loans, or business debts in the package. If borrowers keep paying, the CDO generates steady income for investors. To make them attractive, Wall Street sliced CDOs into tranches, layers designed for every type of investor. Senior tranches, rated AAA, the safe slice, lowest chance of default, but also the lowest return. Mezzanine tranches, rated BBB, middle risk, middle reward, and equity tranches, rated BB and below, the junk slice with high risk but with the promise of high returns. On paper, it looked like a perfect machine. Bundle the loans, slice them up, sell them off, and repeat. But here's the catch. What happens when the collateral itself loses value? That brings us to the 2008 housing bubble, when the very houses used as collateral began losing their value. Back in the 1980s, a Wall Street banker named Louis Ranieri at Salomon Brothers pioneered a radical idea: securitization. Instead of banks holding onto mortgages, he packaged thousands of them together and sold them as mortgage-backed securities. It was brilliant. Illiquid home loans were suddenly tradable investments, opening the floodgates of easy credit. Fast forward 2 decades, and Wall Street had taken Ranieri's idea and supercharged it. During the housing boom of the early 2000s, banks discovered a new goldmine: subprime mortgages, risky home loans given to borrowers with poor credit, little income, or no documentation at all. These shaky loans were packaged into CDOs stamped with AAA ratings and sold as if they were safe. On their own, CDOs weren't evil. In theory, they were bulletproof. But in practice, they became financial time bombs. Not because of the design itself, but because of what Wall Street did with them. Banks got obsessed with CDOs. They loved them because they're a clever way to manage risk and free up cash. When a bank sells a CDO, it shifts the risk of default to investors. Suddenly, the bank doesn't need to care whether the borrower can actually repay the loan. If the homeowner defaults, it's not the bank that loses. It's the investors holding the CDO. This flipped the system upside down. Instead of checking income, jobs, or credit scores, banks shoveled out loans to anyone who would sign the papers. They called them ninja loans: no income, no job, no assets. Because the faster they made loans, the faster they could package them into CDOs and sell them off. In other words, the bank kept the profits, while investors carried the risk. From 2003 to 2006, CDO sales exploded. From $30 billion to $225 billion. That wasn't growth. That was addiction. On the surface, it looked like a miracle: more people buying homes, more money flowing, Wall Street booming. But there was one problem. Even if you gave out mortgages to everyone, the number of homeowners was still limited. So what did Wall Street do? They invented a way to create infinite mortgages without needing new homeowners. They called it the synthetic CDO. the ultimate bet on bets. Now, here's where the madness begins. A normal CDO contains actual loans, mortgages, car loans, credit cards. But by 2005, Wall Street had run out of real mortgages to stuff inside. So they built something new, the synthetic CDO. Unlike traditional CDOs, these weren't backed by loans at all. Instead, they were made from credit default swaps, or CDS. So what's a CDS? Think of it like insurance on a loan. Imagine you've lent money and you're worried the borrower might default. So you buy a CDS, a credit default swap, from a big bank or insurer. You pay regular premiums on it, and if the borrower fails to pay, the CDS seller covers your loss. But here's where it gets crazy. You didn't even need to lend the money to buy a CDS. In practice, that meant you didn't have to own the loan at all. You could just buy a CDS and gamble on whether someone else's mortgage would survive or collapse. In The Big Short, Selena Gomez at the poker table shows it perfectly. One person makes a bet, another bets on that bet, then someone else bets on the outcome of their bet. Suddenly, a simple $10 million game balloons into billions. This meant multiple synthetic CDOs could be stacked on the same pool of mortgages. One subprime loan could have dozens of bets tied to it. The risk wasn't just multiplied, it was amplified to infinity. In The Big Short, here's what really happened. Mark Baum's hedge fund, FrontPoint, believed the housing market would crash. So they bought credit default swaps, basically insurance, a bet against a CDO stuffed with subprime mortgages. Deutsche Bank sold them that insurance, betting the housing market wouldn't crash. Then, Wall Street took dozens of these side bets, bundled them together, and sliced them into a brand new product, the synthetic CDO. So instead of being backed by houses, it was backed by the outcome of other people's bets. Synthetic CDOs inflated the bubble beyond reality. A $1 billion mortgage bond could spawn 10 to 20 billion in bets. When defaults hit, the damage wasn't 1-to-1, it was 10 times bigger. That's why in 2008, the losses were bigger than the housing market itself. They created hidden leverage. Banks, hedge funds, even insurers like AIG were tangled in one giant web. And they fooled safe investors. Pension funds, universities, even local governments thought they were buying AAA assets. In reality, they were holding financial time bombs. So, after nearly destroying the global economy, why do they still exist? Because Wall Street loves them. CDOs free up cash, banks sell the risk to investors and recycle the money into new loans. They spread risk, at least on paper, by bundling and slicing it. And investors, always hungry for yield, still line up to buy them. Today, synthetic CDOs no longer built on subprime mortgages. Instead, they're fueled by corporate credit bets, a quieter, less explosive version of the same idea. According to SoFi, synthetic CDOs remain part of structured finance, though only for big institutional investors. C-Bonds reports that banks like BNP Paribas, Citigroup, JP Morgan, and Nomura still deal in corporate CDS-linked synthetics. And in 2019, Axios even noted a revival, with trading volumes quietly on the rise again. But here's the difference. They aren't the monsters of 2008 anymore. Much smaller in scale, mortgage-linked synthetics are rare. Today's are tied mostly to corporate debt. Stricter regulation, more transparency, closer scrutiny on rating agencies, tougher capital rules, and a different risk profile. Instead of wild subprime bets, synthetics now reference safer corporate portfolios. In short, the game is still on, but with smaller stakes, tighter rules, and a lot more guardrails. It's all part of the money game. Money never sleeps on Wall Street, and neither does on our channel. Watch all the mind-blowing Wall Street stories and explore intriguing money movies all here in one place. Like this video and subscribe to The Money Game to level up your financial game today.